This is the Insight is Capital podcast.
Hello, and thank you for listening to the Insight is Capital podcast. My name is Kerr Daly, managing editor of advisoranalyst.com. We're speaking with Greg Taylor, portfolio manager at Purpose Investments in Toronto. Greg, thank you very much for joining us today on Insight is Capital. Greg, let's talk about cannabis and your unique actively managed fund, the Purpose Marijuana Opportunities Fund, ticker MJJ. By the looks of it, it appears that your fund is outpacing the passive ETF, HMMJ, by about 1,200 basis points. Is that right?
Definitely close to that, yes.
So in the last year, the cannabis sector has been on fire. Volatile, yes, but this is really, it's been one hot sector. What would you say is the reason for the outperformance? And secondly, what's the distinction of taking an active approach in this sector?
So the main thing is when we launched the MJJ fund on February 1st, when we looked at the space, we felt it was still a little overheated from the big run that the marijuana stock sale had in January and out of last year also. So when we launched the fund, one of the big drivers as an active management for me is cash. So we don't go fully invested at all times. So when we launched the fund February 1st, we held about 30 to 40% cash. And we kept that cash on the sidelines until a lot of the companies came back to our buy zone at better relative valuations. As they pulled back in the last few months, we've been deploying that cash and probably got to about 5% cash level, so more fully invested. So we've been able to, more of the cash allocation, be able to try and dampen some of the volatility of the sector, because this is one of the more volatile sectors in the area. And having a strategy that's fully invested, we think, is leaving a lot of risk on the market. So one of the big things as an active manager, to me, cash is one of the biggest drivers of returns, and that's the strategy we're going to use throughout this fund.
And this is actually one of the distinctions of having an active approach to managing a sector like this. I mean, because the sector is so inefficient, it actually provides great opportunities for an active manager like yourself.
Yeah, there's a lot of volatility in the space, and I think being able to trade around positions, being able to change your weightings in companies, especially as we go through a period of consolidation, which seems to be coming up in the space. There's a lot of big companies that are buying medium cap companies, and I think having an active approach, we can position ourselves away from the acquirers and more acute the acquirees, which areas which I think you can add some relative value, and certainly just trading around some hype. There's a lot of hype in this sector, and when the hype meter gets too high, dampening some cash, taking some money off the table is one of the strategies we will deploy. And the marijuana space to us stood out as an area that's really inefficient right now. Certainly in 2017, the space exploded, and we've had different companies that are up 400, 500% in the 1 year. And I think a lot of it is really unique to how the trading patterns work in this area. There's a lot of hype around it, and there's a lot of excitement how big the space is going to be. But I think there's also a lot of myths and rumors that are really out there that people just jumped on the hype. And a lot of the trading is really interesting to me, is that this is a sector that a lot of big institutional investors are not allowed to participate in, be it from regulatory reasons or their own bank doesn't want them to invest in the space. So you've got a sector that hit an over $20 billion market cap last year that is really dominated by either retail investors, hedge funds, or the passive ETFs. There's one passive ETF out there, the Horizons Marijuana Fund, and it's done a good job getting a blanket exposure to the sector, but in my mind, it's become too big. It's almost become a dominant force of the sector because it's a way a lot of people were just getting exposure to the space. So the way I was looking at it is you want an active approach to the sector. It's one of the most volatile areas of the market right now, and just buying a passive index is not the best way to get exposure.
So what would be some examples of companies that fundamentally fit your criteria for a good long position?
So when I'm looking at this space, there's a number of ways I'm coming at it. The first real fundamental view when I looked at it, and I'm a generalist, I look at a lot of different sectors, but this sector really stands out to me with a lot of similarities to the junior oils and junior metal sectors. And it's just sectors that have tons of volatility, have very interesting management teams, And the stocks trade around what people think, but different trading flows and just different rumors on the street. And so what I'm looking for are companies that are really exploiting and being different than just their peers. Because there's a lot of big cap names in the sector that are just doing middle of the road things, nothing really that niche or should be worth what they're getting paid for. So what I'm looking for are companies that are really going to stand out and try and survive the test of time. Because I think in the next few years there's going to be a lot of blow-ups and failures in this space. Companies have raised a lot of capital just with the idea of becoming, it's almost like a mind speculator that they want to come to the sector because they see a lot of people raising money here and getting rich fast, but they don't really have a good business plan figured out. So to me, what I'm doing when I'm looking at the space is trying to figure out the companies which I think have the staying power to make it the next few years, or a niche, carved out niche of the sector that I think will make them attractively valued to other parts of the market. I think to win in this space, there's a few things that I look for. The first is you have to be really low cost. I think that the price of cannabis in Canada is going to drop really fast. There's so much capacity coming on that's being built in the next year or two that I think the price per gram is going to drop quite dramatically. So you can't be a middle of the road grower because I think those guys are going to get completely crushed out of a cost point of view. And I think to keep those costs going, you need to be looking at companies that are doing something different. And something different could be just that they have a niche, that they have a good buying group to sell into, like Quebec, which is like Hodge Apothecary. But I think the biggest thing that I'm going to look for from niche is working on some of the value-added products. I think the sector is really going to transform fast into adding value for the oils, for some of the beverages. And I think companies that are well down the value food chain to do that are the ones that you need to look at that can keep their pricing power. And the third big thing that I think when we look for at these companies is international. These companies are valued well beyond what they can just sell in Canada. And I think to do that, you need to have companies that are looking at growing internationally.
But wouldn't international export be problematic in terms of the law, or is there enough of a market in the legalized, is there enough of a legalized market out there globally for exports, or are you referring to the sort of non-narcotic uses like CBD oils and that as key export markets?
The primary focus of the export market is going to be medical. A lot of companies are well down the path of improving medical for uses in pain. A lot of countries want to get off the opioid addiction crisis, and they're looking at different alternative forms like medical marijuana. And you're seeing a lot of countries such as Germany or Australia that are well down the path of allowing medical, and even the U.S. We're not looking at the U.S. right now, so we're really focusing on Europe, Australia, even some Latin American countries are really going to be where the next big growth is. You are able to export medical marijuana from Canada to these other places, but I think really what the value add is going to be that most of the developed world is watching Canada kind of set the standards of growing, of maintaining quality. And I think Health Canada has gone a long way to validating that they're involved in this process. They're almost coming up with a standard of practices for the entire industry. So when these companies, I think, get the Health Canada stamp of approval, they can go and do JVs in Germany or other countries like that and work with growing there and creating the next leg of growth in the sector from the medical point of view. I think Rex is way down the road, so I think medical is going to be the first wave of expansion in international.
Now, I'm just curious because I think the sort of underlying perception about the cannabis sector is that a lot of the consumption is going to be recreational. But how much of it is actually recreational versus the medical space?
Well, I think there's a bit of a blurred line on that. I think people are using it for different reasons. So I think it's going to be hard to get to the actual solid number in the next few years. There's a lot of people that are saying that the medical in Canada right now is around $1.5 billion. And then the rec market, which is all in the black market right now, would be somewhere in the $4 to $5 billion range. And I think that seems to be holding out, looking at what Colorado and some of the U.S. states have. But it's hard to get to the absolute numbers of what the split between medical and rec is. And I think a lot of that's still because of the black market, which is keeping a lot of the numbers kind of undercover.
On the risk management side, what are some of the key problematic areas that you see? What are some of the areas where you see companies running into trouble?
Well, I think there's a number of areas that are going to prop up in the next few months. And I think that is really when these stocks are really going to kind of separate the winners from the losers. And then once Canada actually does approve the recreational use, and that's when these companies are really going to have to go from being a concept to actually a real business. They're going to have to start reporting gross margins and R&D expenses and how much of their balance sheet is actually utilized. And these are real things that real companies have to report. And for the last few years, the marijuana companies haven't really had to be focused on that. They're just talking about their growing operations, and it's almost going back to just how much capacity they think they can grow and what they're going to do in the future. They haven't actually had to do anything. Once the rec market actually does take hold, then I think it's going to be a big development, and these companies are going to have to go from being concept to actually proof of concept. And that's when I think the management teams are really going to have to show what their value is. And that's really, I think, that some companies are just not set up for that. And that's where I think there's a lot of risk. The biggest question for the entire sector, though, to me, is creating brands. The winners in this space will be the companies that can create the best brands. And it's going to be incredibly difficult to create brands for a lot of these companies given the way the provinces are set up, how they're going to sell it in Canada. Every province is different. They're handling distribution different, and they're going to control the marketing spend a little differently. And I think the biggest risk the way Canada's going at it is that it's going to stymie the ability to create a brand in Canada. And you're going to have a lot of fragmented brands that are going to be more gray markets. Someone's going to tell you about it. You might hear about it on the internet, but it's not going to be able to create a massive brand like a Molson Coors or a Labatt, which I think the way that the alcohol industry's gone. So the biggest risk for the Canadian guys is that they'll be able to grow and carve out niches, but they're not going to create the brands, and the brands are going to come from other countries.
So there's at some point in the future, there's going to be, and that could come sooner and it could come later, but there's going to be winners and there's going to be some key big winners, and then there's going to be a lot of losers. In your fund, one of the unique benefits or features of your fund is of the Marijuana Opportunities Fund is that you're able to short individual stocks in the sector. Are there some examples of where companies have already disappointed, or that you see them coming into disappointment, simply not prevailed competitively in the space already at this point, at this early stage, that there's an opportunity to take short positions against them, or is this more of a future keeping the door open to having the ability to short?
The fund has done some short selling. It's a little hard to do right now, given that the borrow cost isn't very available and it's also very expensive. So shorting comes from more of a one-off trading oriented point of view, but it happens more of on a more of a one-off event. Certainly, we are seeing fairly big disappointments in the space already. Afria, which was a company which was probably the leader in the space last year, really disappointed a lot of investors in January when they made a big acquisition of Nuvina, which cost a lot of money. And I think it kind of shocked the street that they paid that much in stock for a company that didn't really have that much to begin with. And I think the stock's really suffered since that point of view. So Aurora is another example of a company that's done a lot of acquisitions, and the street's really not been a big fan of some of the acquisitions and deals they've done. So you're already seeing that in the concept stage as people are going through rolling up the sector. We haven't really had any big blow-ups from the actual operations yet, just because we haven't really seen the numbers. A lot of the companies are really hanging on for rec legalization, so they haven't had to do actually any real business yet. That will come in the second half of the year, and we may not even see till Q1 of next year. But I think that's when we're going to really see the companies that actually can do what they're saying, because right now there's a lot of promises and they haven't been held accountable yet.
Yeah, they haven't had to pass muster yet because they're still pending. So, keeping discussion with the sectors, what's your outlook now for the energy sector, which has been enjoying a really great run? Is it a sustainable trend?
I think it is. I think there's been a number of things going on here. The Canadian energy sector has really been a laggard over the last few years, and even within the global energy sector, the Canadian energy stocks have lagged. energy as a group really suffered during the last few years. Just there's a lot of concerns about supply coming on too fast, whether there was demand destruction coming out of slowdowns in Asia or the emerging markets, and that put a damper on a lot of sectors when oil hit the lows in the 30s a few years ago. But the commodities bounced, and a lot has actually doubled off the lows, and a lot of the Canadian energy stocks really haven't, which has lagged a lot of their international peers. There's a lot of made in Canada problems that have hurt the energy stocks. Certainly everyone knows what the pipeline concerns, and it's just one of the realities of the Canadian energy sector that we are at the end of the pipe. So every other piece of oil produced that comes out of the ground in North America gets sold before they get to ours to fill in the pipeline. And that's really been the big disappointment, that we haven't got a specific solution to offtake some of the energy in Canada, which is really starting to hit the producers in Canada and cause their pricing differentials to widen. So they're selling at actually a lower price. We've also got tariffs. There's a law last year we had to worry about if there's going to be if the energy sector was going to be caught up in a border tariff, which seems to be have gone away. But it really caused the sector to be something that people could ignore. And in the Canadian market, the energy sector really does dominate. So when the energy stocks aren't working, the Canadian sector just underperforms. And you really didn't need to own the energy stocks for the last few years. People could have pretty good years by buying the banks. They could buy some of the consumer companies, and they could max out their U.S. allocation in a lot of funds. And I think that started to change in the last few weeks. We've seen the oil price has done well, mainly on the back of the Iran sanctions, but there's been a lot of good news also from the inventory point of view. Just as inventories get depleted, that's offered a bit more comfort that this bounce in the oil price might be sustainable. And you're seeing a lot of people come back to this space. And I think that the big wake-up call for the Canadian sector was the Canadian Natural Resources block of Shell, which was sold a few weeks ago. This was a big overhang on the sector, stock, and $4 billion. And the fact that it cleared and traded higher after the fact, I think is a big wake-up call that these deals can get done. There's buyers out there. And the interesting thing I was hearing talking to different traders is a lot of the buyers in that deal were actually Americans. And I think that when Americans can kind of come back to the sector, they're the big swing buyer. So when Americans come back to our sectors, they do well. When Americans pull away from our sectors, we underperform. And it feels like we're coming back in that sweet spot that international buyers are coming back to the Canadian energy stocks, which should be setting up for a run for the next few months.
That sounds exciting, actually, in terms of the way that you've stated it. I think the endorsement of U.S. investors seems to be, it seems to be a big deal across our market, across Canadian equities, but particularly in the energy sector, when the American investors come back, that tends to pave the way for the rest of the world.
Yeah, it's simply a flow of funds argument that the market's really, there's limited dollars attached to equities, and when markets flow back and forth, and the Canadian market's really been out of favor, and we've felt that in the market. But if that tide changes and people start coming back to our market, that can go a long way to making things work again.
Well, I mean, in the years of where the market was in reaction to, pure quantitative easing, it seemed like, the only place to be was mainly in U.S. equities or in equities in general. But, fundamentals didn't seem to matter, and active management didn't seem to matter for a long time. But now, with the return of more normal behaving markets, more markets that are looking at fundamentals again and looking at inefficiencies, seems to be that there's a lot of opportunity out there that was being ignored, just like the energy sector.
Yeah, the market over the last few years has really been momentum driven. People kept buying winning stocks and ignoring the lagging stocks, and there was really no mean reversion. Over history, most of the time you can look at a market that's more on the sine wave point of view, that you can sell winners, buy losers, they'll all mean revert, and you can have a pretty good return at the end of the day. The last few years has really been an anomaly that they haven't had these mean reversions, and the crowded trade keeps getting more crowded, and we certainly saw that with the FANG stocks, which just kept going up every day. And lagging sectors such as the energy stocks really didn't do much. Now we're seeing a bit of a break in that as the people get more comfortable that the oil commodity might hang up here. And really, if that happens and you're starting to see some good numbers being delivered from these companies, what you might get kicked in as the next buyer are the quant funds. A lot of these quant funds are really driven off of models that show, look at earnings growth. I only want to buy the top quartiles of earnings growth companies. And as the oil companies start putting up numbers which are starting to stand out in the face of slowing growth in other areas, you could see the quant funds and the earnings momentum-driven strategies come back to the sector, which could be another leg of growth.
You know, it's exciting because even if you just consider just, you know, across the market a move to rebalance out of expensive areas into value, that could also prove to be a very exciting prospect for value investors as well as of course under the sector rotation strategy. There's so many fronts where markets can change given the change in sentiment and given the change away from momentum. But now, recently, Greg, some U.S.-based investors have been quite vocal or have been active in terms of the Canadian banking sector, taking short positions against the big Canadian banks. What are your thoughts on this?
It's really tough to call. There's certainly been a big short Canada bank as trade on for the last number of years. And it didn't really work in absolute terms, but it worked in relative terms. I think Bank of America Merrill Lynch was one of the big ones advocating the trade a few years ago. And the trade they had on was go long the U.S. banks and short the Canadian banks. And while the Canadian banks didn't really go down, the U.S. banks went up a lot more. So that trade actually worked. But the hedge funds seem to be coming back to try it again. And it's interesting to see how it'll work this time. Certainly Canada has its own problems. Certainly trade is always going to be an issue with the NAFTA dispute still out there. And everyone knows about the Canadian debt problems, that there's a lot of household debt, and we'll see what the growth is going to be coming out of the sector. Right. But the Canadian banks are really hard to say that they're actually going to really get hurt. I think saying they're going to blow up on the housing crisis is kind of looking in the rearview mirror and trying to replay the last housing crisis that we just saw in the U.S. And usually what the next crisis isn't the exact same as the last one. We've already gone through a housing crisis, and I think the banks are pretty well positioned to look for another one to try and make sure they've offset their risk, or they've hedged out a lot of the risk so they can handle a downturn. So the next crisis is going to be something that we're not going to know what's coming. So looking at Canadian banks as really getting hit on Canadian housing, I think, is a bit of a long shot. It's not far to say the Canadian banks aren't going to have a lot of growth. A lot of the mortgage growth is going to taper out in the next few years. So really where they're going to get their growth is from the international expansion they've done. And certainly some banks have been way better than others at doing so. TD and Royal have certainly had big wins in the U.S., and Scotia's done pretty well expanding into Latin America. It's looking at the other banks, we're going to see where the growth is. Commerce and National are the ones that kind of stand out as ones that are more domestic focused and might have a little more of a harder time to grow from a top line point of view. Certainly from an earnings point of view, you're going to see a lot of growth because these companies are still just cash flow machines, and the amount of money that they're putting back towards buybacks will add some more of a fake earnings growth just through getting rid of the number of shares out there. But it's going to be hard to see the Canadian banks really blow up. So while they may lag other sectors, I think the short Canadian bank trade is more of a relative term trade.
Greg, just in general across the market, being a sector rotator, I mean, in terms of your investment strategy, Greg, what areas of the market are you reducing, and what areas of the market have you been adding exposure to?
So what I've been looking at in the market is that I think we're going to see that some of the crowded trades really come off. Everyone has been hiding in these momentum strategies, most notably the big internet names and technology. And while they're great companies and they've done a lot of good things, I think the valuation got a little stretched. And just the question is, who's going to be the next buyer? Anytime you buy a stock, I think you have to always think of who I'm going to sell it to. And when everyone owns a stock, it's going to be hard to say, I think this is the stock that's going to keep winning. So I've been selling off some of the big internet names, trying to just trim down some of that exposure and looking at areas that really have been ignored. Certainly we've talked about the energy stocks. I think some of the other commodities are going to do well also. I think if global growth really takes off, the basic materials and the metal stocks could be setting up for a fairly good run. Certainly some of the data coming out of the emerging markets is doing quite well. Europe seems to be turning around, and that's usually pretty good for copper. Some of these copper names are looking fairly attractive. So I think setting up that basic materials, energy, the cyclical trade could be on in the second half of the year. So that's the area that I'm positioning towards.
Greg, it's been a volatile start to the year, something a lot of investors welcomed, and earnings have been really strong. But the market hasn't actually taken that to heart.
Yeah, I think this really is setting up for an interesting year, and certainly the volatility coming back is something that I think all active managers have welcomed. Certainly as an active manager who likes to trade around volatility, the last few years have really been rather dull. Markets that have slowly ground higher up are really hard to beat, and it's really just something that people have been able to just win by buying momentum. And I think the momentum trade, while still going to be there, I think volatility is coming back. And certainly looking at the way the stock market's acted over the last few months has been really quite fascinating. Certainly we're getting a lot of really strong earnings numbers coming out of the U.S. And a lot of that is really juiced by some of the tax cuts, which have hyperinflated the growth of some of these companies' earnings. But what's really interesting is you're seeing that the stocks are not really reacting to them. You're seeing earnings grow at double digit, but stocks basically be flat, which really means that the multiples are contracting. And that means that everyone knows that the good news is coming, so everyone's saying, well, what's next? And I think that's all setting up that the market really has priced in a lot of the good news, and we are trying to see what's next. Is the second half of the year going to be strong? Is global growth going to keep going into 19 and 20? And that's really what I think the real uncertainty is in this market right now. So I would expect for the balance of the year to be increasingly more volatile as investors try and figure out how much of the earnings growth that we saw in the first quarter is real and sustainable, and how much was just sugar-coated from tax cuts. And then what multiple do you want to put on that? Because if the earnings growth isn't sustainable, I think you want to discount your multiple, which could cause for a sideways market.
Do you think there's any surprise good news areas aside from things like the repatriation of offshore funds and the tax cuts coming into play? Do you think there's any good news that is unknown yet by the market, or in terms of efficiency in markets? Do you think a lot of that good news has already been factored in?
I think the good news is going to come from just striking off the risk of bad news happening. And that's more that there's a lot of concerns in the market about trade. Are we entering a trade war with China? Will NAFTA ever be settled? If we can get past that with those issues being resolved, I think that would be a boost to the market. There's another thing would be just what's the bond yield going to end up at? There's a lot of concern with when the 10-year in the U.S. hit over 3%. Would that cause a lot of stocks to suffer? And it didn't really matter that much. So I think people are getting more comfortable with the 10-year getting back to normalizing over 3%. Now maybe if it's 4%, that's a different story, and that could cause people to start to question valuations and multiples. But really, as long as people get through these hurdles of trade, higher bond yields, and also watching the dollar. The U.S. dollar's had a fairly big run, and what the impact that can have on a lot of companies and their earnings. But as we get further through these events and that the world doesn't really suffer any other events, then I could think people could get more confident and they'll start paying up and the multiples will expand, which is good for the market and should see higher returns.
In general, Greg, is your outlook for the next 12 to 18 months positive, or is it flat or negative?
I think looking at different geographies is going to be fairly key. I think the U.S. market has a risk of being flat to slightly higher in the next few years because, again, a lot of the good news is already priced in. I think the Canadian market has potential to play some catch-up as the energy and material stocks get going. So we could see positive returns coming out of the Canadian market over the next year or so. Europe and Asia, I think, are probably more along the lines that they'll have positive moves as well. Again, so I think it's more that the winning trade, which has really been the American trade, is going to probably come off the front burner, and we could look at a catch-up move from some of these other lagging sectors, such as Canada and the emerging markets.
Thanks, Greg. That was very enlightening.